back to the GEX Private Equity Academy podcast. I'm Vanamali, CEO of GEX Management, managing partner of GEX Capital, and the founder of GEX Private Equity Academy. Today, we're discussing one of the most important risks private equity investors evaluate when reviewing acquisition opportunities: customer concentration. Now, customer concentration may not sound nearly as exciting as revenue growth or valuation, but in many lower middle market acquisitions, it becomes one of the most or the biggest drivers of investment risk. Why is that? Because concentration creates dependency, and dependency creates risk. Let me give you a simple example. Imagine two companies. Both generate $10 million of revenue and both generate $2 million of EBITDA. Both operate in attractive industries. At first glance, they appear very similar, but company A has 200 customers. Its largest customer represents only 3% of revenue. Company B has one customer representing 30% of revenue. Suddenly, those businesses don't look so similar anymore. What happens if company B loses that customer? Revenue declines immediately. Profitability may decline significantly, and the entire investment thesis could change overnight. That is why I spend a tremendous amount of time evaluating customer concentration whenever I'm reviewing an acquisition opportunity. One of the first questions I ask is this: how much revenue comes from the largest customer? Then I ask, how much revenue comes from the top 5 customers? How long have those relationships existed? Are there long-term contracts? How difficult would it be for the customers to switch providers? How dependent is the customer on the company? And just as importantly, how dependent is the company on that customer? Those are two very different questions. A customer may represent 20% of revenue, but if the relationship has existed for 20 years, switching costs are high, and the company provides a mission-critical service. The actual risk may be much lower than the percentage alone suggests. This is where private equity becomes much more than analyzing spreadsheets. It becomes a business judgment exercise. One thing that I often tell our associates is that customer concentration is not automatically a deal killer. Almost every business has some level of concentration. The real questions are: can we understand the risk? Can we manage the risk? Can we reduce the risk after the acquisition? Those are the questions experienced investors focus on. For example, if a business has one customer representing 30% of revenue, our investment team may ask, can we diversify the customer base? How quickly can we do that? What happens if the customer level leaves next year? Would the company remain profitable? Would lenders still support the transaction? Would our investment thesis still hold true? Those questions are far more important than simply looking at a percentage. Another common misconception is that concentration only applies to customers. In reality, investors evaluate concentration across many parts of a business: customer concentration, supplier concentration, employee concentration, referral source concentration, management concentration. In many businesses, a small number of relationships drive a significant portion of enterprise value. Understanding those dependencies is one of the primary objectives of due diligence. Customer concentration also has a direct impact on valuation. Two companies generating identical EBITDA can receive very different purchase price multiples because one business is a lot more diversified than the other. And why is that? Because investors pay for predictability, they pay for stability, and they pay for lower risk. Businesses with diversified customer bases generally provide greater confidence that future earnings will be sustainable. And that confidence often translates into higher valuations. One of the themes you will hear repeatedly throughout this podcast series is that investors are not simply evaluating what a business looks like today. We are evaluating what could happen tomorrow. What happens if a customer leaves? What happens if a contract is not renewed? What happens if a competitor enters the market? What happens if the industry conditions change? Great investors spend a tremendous amount of time thinking about those scenarios before making an investment decision. Because once the acquisition closes, those risks become your risks. At the end of the day, customer concentration is not really about percentages. It is about understanding dependency. The more dependent a business becomes on a small number of customers, the greater the potential risk. And understanding that risk is one of the fundamental responsibilities of every private equity investor. Because great investments are not built by avoiding every risk. They're built by understanding risk, pricing risk appropriately, and managing risk after the acquisition. Thank you for joining me for this episode of the GEX Private Equity Academy podcast. If you would like to continue learning how private equity investors evaluate real lower middle market acquisition opportunities, I invite you to join the GEX Private Equity Academy Insider List. As an Insider List member, you will receive our complimentary private equity starter kit, transaction insights, educational resources, and invitations to select live private equity case study sessions. If you found this episode valuable, I would also appreciate if you subscribe to the GEX Private Equity Academy YouTube channel so you do not miss future podcast episodes, acquisition case studies, and other educational content. To learn more or to join the insider list, visit www.gexprivateequityacademy.com. Thank you again for joining me. Until next time, keep asking better questions, keep evaluating opportunities, and remember, do not just look for great businesses. Look for great investment opportunities. Thank you.